This has got to be one of the most hated market rallies in a long time. And don't get me wrong, I'm part of it. After CPI and FOMC, markets have really just stabilized near those all-time highs, far better than I would have thought considering the massive breadth contraction. Nvidia, Apple, and Microsoft really seem to be holding things together quite well up here, so there's still those bearish divergences out there, but nothing worth acting on until hourly lower highs are set in the index itself. Welcome to the Trade Brigade Weekend Show. My name is Matt, and I want to walk you through those data points in today's session. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe before we get started here, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, solid green-bodied bar, basically no upper wick, no lower wick to really read into from a psychological perspective, and a very strong close from the buyers in the upper third, basically at the highs of the weekly range here. If we're thinking about location on the bar-to-bar count, we do have a higher low as well as a higher high and a brand new all-time high close. Buyers go 2 for 2 on the weekly count. If we're thinking about trend, we have lows, soft higher lows in here because we never really fell into a firm daily downtrend during that pullback here. And along the way, of course, we had highs, higher highs, and we're sitting on the highest high, the latest all-time high. So the trend is up. There is no indication of a pullback looking imminent on the weekly time frame chart, but if something were to emerge, there's really 2 locations that I would pay attention to. The top of this breakout area from in here, as well as the previous all-time high. We'll see these levels more clearly on the daily in just a moment. The line in the sand on the weekly time frame chart would really be this level, the previous all-time high, because if we come in here with a Fibonacci coming from the bottom of the move up to the tippity top and extend this off to the left, you'll notice previous all-time high acted as support once. It's our 38.2. Technically, this would constitute bull flag consolidation, and we'll look for follow-through in the upward direction over time, noting that the prevailing winds behind us are, of course, in the upward direction. If we take that off and bring out the spiders, weekly anchored VWAPs, you'll notice over time this will also provide confluence at the previous all-time high. This big line in the sand is basically at 525 flat on your SPY Cash ETF. Let's bring out the volume profile just to take it all the way home here. And as we know, the highest volume node shelf is the previous all-time high as well. Lots of confluence at that 525. So this is all fine and dandy on the pullback, but we just mentioned how there's really no indication on the weekly at least that a pullback looks imminent. So let's talk about upside targets as we move into blue sky territories with some Fibonacci extensions. We can look at the 100% extension of this bull flag. So from point A to B to C on the pullback, that measured move is up around 551. That's certainly within striking distance in the next week's worth of trade, so I would carry that forward as a key level here on the weekly. We could also bring this one in where we come in from the bottom here up to the top and the pullback low of that move. It's a little bit higher, closer to 558, we'll call it for round numbers sake. And again, these levels are within striking distance. These are not pie in the sky sort of exaggerated targets. I would watch those as we're moving into blue skies if the trend continues in the upward direction here. Let's bring it on down to the daily time frame chart now that we've really understood that the weekly trend is in control of the buyers. And on the daily chart, we'll begin with the weekly expected move. We have a shortened holiday week with Wednesday, the markets being closed for Juneteenth, but let's evaluate that expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 549.41, implying a higher high and a brand new all-time high. If we're contained by the lower bound, the number is at 536.23. That's certainly a higher low here on the daily trend. It's also confluence with our gap fill reversal from the Tuesday high. Of course, Wednesday on CPI is when that gap up occurred. So I like that from a confluence perspective to the downside. Of course, on the daily time frame chart, the trend is up with lows, higher lows, massive higher lows, and we don't have any hourly downtrends at any point since this last higher low. So there is no next higher low to count. And obviously along the way, we've produced this massive new all-time high. So we can certainly afford some sort of pullback on the daily. And the 2 levels that I'll continue to reinforce, we talked about this on Wednesday, would be a gap fill reversal off the lower edge of the weekly expected move. That level is at 537. Lower edge of the weekly expected move is slightly below 536.23. And then even if we were to rotate to the bottom end of this small balance over here and produce a daily higher low over the top of the previous bearish engulfer open, or the top of this balance range here, the line in the sand is at 531.40. As long as we're over that on the daily time frame chart, I would be on the lookout for a huge daily higher low to continue the trend in the upward direction. Obviously, if we break out of this 3-day range up here in the upward direction, it's just blue sky territories that really takes care of itself. Whole and half dollars, any intraday levels that form. Let's bring it on down to the hourly time frame chart here and really start to get granular, because this is where we can continue to evaluate who's participating in this market. Is it stronger sellers? Is it stronger buyers, momentum buyers, dip buyers? Who's getting involved here? So let's rewind all the way to Tuesday just to reinforce the idea on Tuesday that we opened lower inside of this previous range. We looked under the lows and we did not find an hourly lower high underneath 533. We actually got consolidation back above for the Brigade Bolt, and we rotated to the top of the range. So this is checkmark number 1 for dip buyers remaining in control. Obviously, this is a momentum move in the upward direction, but on the actual Wednesday session, we got some Jerome Powell volatility. I would argue that we closed, fairly unchanged. Basically, here's the opening print, right? So it's not like we had momentum buyers continuing to step up on that Wednesday gap up. But if we think about what happened in the next session, right? We opened here, we looked into the gap. Did we have stronger sellers emerge? The answer is absolutely not. So we don't have stronger sellers, and dip buyers, once again, are rewarded by a trend developing into the afternoon higher in this overall balance. If we looked at what happened on Friday, it's the same concept. We did not technically make a new lower low. We did not look further into the gap underneath us. But if we had stronger sellers who were really participating in this market, you would have thought that there would have been some momentum, some attempt even. It didn't even have to be on momentum. It could have been a slow grind to the downside, but to close that gap where there's quite literally no structure because of how fast the move happened in the pre-market during CPI. It just simply has not taken place. So I would not be shorting this market aggressively until we can actually spot the hourly lower high. If we're inside of the balance range, so be it. Two-sided trade can take place. You want to be long off the lows and short off the highs. Just ping pong back and forth. Ideally, because the weekly trend is up, the daily trend is up, we know that dip buyers have been in control here. If we get a break through the highs of the balance range in here, you would like to see momentum buyers step up, and the Brigade Bolt would be a higher low over 544 to target the upper edge of this week's expected move, as we were just describing, at 549.41. Of course, the weekly measured move targets start to come in at 551 and then 558, which we were just looking at from a Fibonacci extension perspective. The downside, again, is fairly self-explanatory. If we get a lower high, you could look for the trade from point A to point B down here, but I would not overstay my welcome in a market that has clearly been dominated by dip buyers. At point B on the gap fill reversal, I would be thinking about exactly that, a stronger reversal for the daily higher low that we were just describing. So if we do get something that looks like this, where's the double bottom? Where's the inverted head and shoulders? Where's the simple hourly hammer candle down here? That would suggest buyers are stepping up. We would, of course, retarget the bottom end of the range overhead, and then the equal high would be the next step after that. If the market's really going to break down more aggressively and give you a deeper daily pullback into this zone, then so be it, right? This is okay. You could get something that looks like this. Any really weak consolidation here at 537, if you don't see a double bottom, if you don't see any sort of inverted head and shoulders, no signs of buyers stepping up there, then great, there's possibly a second leg out of a bear flag that would take us into our daily line in the sand, which is really this zone down below. We know that dip buyers have stepped up here once in the past, so I would look for them to do the same thing once again at 533. Now, I also want to caveat here, because there are still bearish divergences across the broad market, it wouldn't be unreasonable to take the short from point A to point B. The whole idea is just that you recognize you're in a daily uptrend, you're in an hourly uptrend even at this point, and you don't really overstay your welcome at point B. You're not looking for this market to crumble and drift all the way back down to 500 as a round number target. That's pretty unreasonable considering the stance of what's been going on right now. So the shorts are available, but again, just don't overstay your welcome. The market has proven to us that shorts are not rewarded, and buyers, dip buyers specifically, are the ones being rewarded in this current context. Let's bring out the intraday anchored view apps. You'll notice that this is pretty stable and flat. So this is from the Wednesday gap up, stable and flat inside of the 3-day range. that really indicates to me more neutrality than anything else. I would tend to be exactly that, neutral inside of the range. The best trades will come from resolving the upper bound of the range with some sort of higher low over 544. If the market aggressively on Monday makes a move to close the gap, guess what's going to be right there? It's going to be your first anchored view app from the cluster below us, on that Wednesday gap fill reversal from 2 weeks ago. So really liking the confluence at 537. And even if we come in here with a Fibonacci retracement, let's come in from the ideal place to start it is when the last real big cycle to the upside happened from. So this is technically a lower low here. So we're going to come in from this level. It's also the failure of the sellers, right? And you'll notice that the 61.8 is directly at that 537 as well, just reinforcing the entire idea that if this breakdown does occur, I'm really paying attention to whether or not dip buyers step up here. And once again, it's not like we're just blindly buying this level. Please wait for some sort of confirmation that buyers are stepping up, but really interested in that 537. Let's also talk about the range double, right? If this is a balance range overhead, typically a measured move target is a range double. If that doubles to the downside, there's your measured move target right at 537. So is it all clicking yet? Do these levels really make sense? I certainly think they do from my perspective here. The last thing I'll give you, because I do think that this is possibly, given the bearish divergences, I think this is something that could unfold, right? Is the opportunity for a look above and failed. And this is just a very classic balanced situation where you look above the top of the range at 544, fail back into the range with a lower high beneath. Now you're targeting the bottom end and probably the gap close beyond that because you have disappointed longs in here, right? So breakout buyers are not rewarded. There's a short that emerges on the lower high back in range. And because of the bearish divergences across the broad market, you could probably take that trade as well and not be overly concerned about, okay, I'm trying to short this thing near all-time highs. You know, if the broad market's coming in, if we're also seeing some underperformance from the big names, Microsoft, Apple, Nvidia, of course, then I don't think that this is unreasonable as a possible idea. So the look above and fail, it requires the lower high underneath 544. Let's continue to get into some more supporting evidence here. The market internals are always Exhibit A. If you're not familiar with this sort of dashboard, check out the video tutorial in the top right-hand corner. Really interesting because, again, as the market's balancing near these all-time highs, notice that for the most part, breadth is not strong on Wednesday. It's certainly outflows on Thursday, outflows on Friday, getting pretty close to substantial outside reads at negative 300 million there. If you were watching intraday, the NYSE breadth at times was like down -9, pretty substantial and severe to the downside. The advanced decline line is negative on Thursday, negative on Friday, as we're really just grinding sideways in that range. So once again, the bearish divergences are there, which is why I'm not totally afraid of shorting the market if the setup presents itself at the all-time highs. You will notice that the index score here is completely flat on Friday, and this was actually a huge saving grace. So that index score measures about 25 data points across the market. It's not just a culmination of the internals dashboard here. It's other things, and it weights them accordingly. It really prevented us from being overly aggressive on the short side at the lows of that sort of Friday move over here. The next thing I want to do with you is a little bit of an exercise out of the tick, and the tick represents, if you're using this indication as a sort of a base level here, that's the entire exchange level. And I have this set in the cumulative to the entire exchange, NYSE exchange as well, with just TICK. If you actually look at just the S&P 500, let's come in here and let's edit this, and let's go on down to the SP, TIK SP. Let's load that up. Notice how flat this was. So in terms of like breadth and magnitude of breadth, the S&P 500 itself was not actually horrific on the Friday session when you're using the cumulative read for that specific index, right? Not the entire NYSE, but the index itself. So as we're balancing here, we can see the concentration risks really start to emerge that, all 2,500 plus, equities listed on the NYSE aren't necessarily performing well, but the S&P 500 itself, it's not like it was detrimental, throw everything out the window. Oh my goodness, breadth is so bad, we should really start shorting this thing into the ground. So just sort of balancing the data points and again, walking through everything I feel is relevant as we head into the upcoming week. Here's the market profile to finish up the S&P side of things. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. I do want to point out here and keep it simple to begin with, the fact that value and point of control continuously drifted in the downward direction as this balance is taking place, right? So you'll notice point of control, and point of control. That, of course, is progress from the sellers. But if we're thinking about, again, how we actually make a trade come out of this, it probably requires turning all of this into overhead supply, aka finding acceptance inside of the gap underneath us, which was the whole premise of the SPY hourly analysis that we were just walking through. Another thing to carry forward here is the lack of material excess out of the Wednesday session high. We just hardly, sort of cut over it on the L session there, but the lack of material excess, in my view, means that the auction is incomplete at the all-time high. Generally speaking, if we were to revisit the top end of this 3-day balance, I would expect a breakout there, and then the big question just becomes, do higher lows emerge above? Does value shift to above this balance range here? Or let's just say, for example, right here is the Monday session. We open up and we're doing something like this. The market's sort of balancing over here. It's a little bit lower, right? And then we break and we close up here. If value on Monday is still inside of this range, and this would just represent value, right? If that's the case, then I might not be a true believer in the breakout of the move yet. I would want to see value actually over the all-time high, over the top of the 3-day range, if we're really looking for that next leg in the upward direction and price exploration in these blue sky territories. So that's really it out of the S&P. Let's take a look at the NASDAQ. Here we have it, QQQ on a weekly time frame chart. What do we see in terms of candle structure and location? Do we even have a lower wick on this bar? Hardly. Certainly no upper wick on it. So structurally, buyers are in control with an all-time high close, dead on the highs of the weekly range. Bar-to-bar count does yield a massive higher low and a massive higher high. It's bulls on parade out of the NASDAQ. If we're thinking about trend, of course, it's up with lows, higher lows, massive higher lows along the way, highs, higher highs, and we had higher highs here sitting on a brand new all-time high. The trend is up. There is no indication of a pullback looking imminent, but if something were to emerge out of the QQQ, I would be primarily concerned with loosely 460 here on the weekly time frame. It would be a 100% retracement of last week's bar, but the preference, and based on the bullish indications so far, would be that that wouldn't happen in the coming week's worth of trade. Even if we were to find ourselves down here, I would start thinking about weekly buying opportunities to use previous areas of resistance now acting as support. If we were to go beyond that, a huge line in the sand out of the QQQ is just the top end of the 7-week balance range from this area back here. Obviously, if we bring in our Fibonacci's from the lows up to the highs, the 38.2 is more so aligned with the previous set of range highs over here, slightly in between our two key areas. So ideally, this would be bullish consolidation looking for upside over time. If we bring out the anchored VWAPs on the QQQ weekly, we're above all of them, of course. This is bullish. And if we take a look at the volume profile, zooming out here, the highest volume node is the top end of the multi-week balance range. So there's plenty of room to pull back and look for a higher low based on a volume perspective. We will take a look at some of the measured move targets here coming in from the pullback low up to the 7-week balance range highs. Did we hit the 100%? Yes, we actually did last week, so that's my apologies for not checking in on that sooner, but we'll come in from here up to here and the pullback low to get our 100% on this one, and that would be up around, let's call that 491 for round number sake. Again, that's certainly within striking distance in the coming weeks worth of trade if everything remains firing in the upward direction. Let's bring it on down to a daily time frame chart, back on over to the QQQs, and we'll zoom in here. Let's firstly evaluate this week's expected move. We already showed you the tutorial in the top right hand corner. So the expected move, if contained by the upper bound, is 487.32, implying a new all-time high, higher high in the trend count. And of course, the lower bound is at, what is that, 471.02. That is, of course, confluence with the top of the gap, not the bottom of the gap, like what we saw over in the S&P 500. So expected move does strike me as being bullish, especially when we consider, of course, the trend is also in the upward direction. No hourly downtrend. So this is your last daily higher low. I hate to be that guy and really go way out there on a limb, but the daily chart could, in theory, yield a higher low anywhere over that weekly structure we were just describing. We called it 460, but more accurately, it's 459.25. Now, ideally, a higher low would be a gap fill reversal. It would be support over the top of the multi-day range that broke out here into the afternoon on the Tuesday session at 465. So I would definitely carry those levels forward on the daily time frame chart instead of just, throwing caution to the wind and saying, oh no, Matt said 460 it is. No, gap fill reversal is much better, 468, and the top of the multi-day range that broke out is is at 465. Remember, we want to use previous resistance as a new area of potential support to find that higher low. Upside takes care of itself. Blue sky territories, whole and half dollars, intraday levels that form. Remember, 491, is that measured move target in the upward direction. Let's take a look at the hourly time frame chart here and see what else is going on. What else can we learn? So this is not so much a dip buyer's market, but rather a momentum market. Notice that, sure, off the lows, you're getting a little bit of that dip buy activity, but momentum breaks you out over these highs, right? Momentum breaks you out and continues the trend after the CPI gap up. It's a gap and go, not so much a gap and sort of fade and sideways activity. This is a pretty solid looking reversal off of the structure. It did undercut it a little bit, but again, let's ask ourselves the questions. If you're a stronger seller and you're getting this sort of gap up to all-time highs, you're thinking, oh great, here's the exhaustion gap. It's finally going to make a break to the downside. Where do you want acceptance on that Thursday session? Obviously, on the break back down into Wednesday's range, ideally it's just a lower high in consolidation in here. It's simply not the case, and we close at all-time highs on Friday, breaking out over the open of that Thursday session into Friday afternoon. So I'm not seeing any bearish arguments here out of the QQQ NASDAQ, which shouldn't be a surprise because we know that this is where the tech concentration is anyways. This is where your Microsoft, your Apple, your Nvidia are really going to shine. So is anybody shocked that the QQQ looks stronger than the S&P? I'm not, right? If we think about possible trades into the upcoming week here, I would love to see just consolidation and breaks over Friday's high for continuation in the upward direction. If the hourly chart does want to break down, great, show me a higher low here. If we're counting trend on the hourly, let's just go from the gap up. It's lows, higher lows, higher lows. This could easily yield a higher low here at 475.35. If we find that, there's a couple of trades. If you can spot the reversal there based on an hourly hammer, based on the double bottom, all the classic indications we talk about, right? That's great. You could take it here, or you could just take the break back up through the opening print from Thursday on a higher low, and you're back off to the races into blue sky territories. The time where I would say the sellers might achieve a bit of that stronger daily pullback is on a lower high underneath your 475.35. If you get this lower high back down inside of the CPI and FOMC range, I would tend to think that this starts to look a little bit more like a failed breakout on Friday afternoon, and we're also underneath all of the consolidation from Thursday, where it's possible that people were building, that long position in the first place. So 475.35, a lower high underneath, targets the low of day from Wednesday. And of course, anything beyond that is the gap close for your first attempt at a daily higher low at 468. So again, what's the question when we get down here? Do buyers step up? Is there a double bottom? Is there an inverted head and shoulders? It's just a rinse and repeat at these levels. I know it sounds like I'm a broken record, but it's really the name of the game when you're trading at all-time highs. Let's bring out the Fibonacci's coming in from the same reference point that we used in the S&Ps. Your 61.8 is the gap fill reversal. That's 468. Confluence there looks pretty good. If we bring out the intraday anchored VWAPs, great confluence off of this one so far. Your gap up Wednesday anchored VWAP is over that 475.35. This to me reinforces the idea that if you are looking for a short, I would really want to see the breakdown underneath that anchored VWAP, underneath that 475.35 before swinging for the short, not really looking at like this would be a really unattractive short, like a very quick lower high under 477.85. Probably going to pass on that as an idea and more so be focused on the higher low opportunity here for the reversal back in the upward direction. Let's take a look at the market internals for the NASDAQ side of things. Not as bad in terms of breadth on that Friday session. We all know why, thanks to the Magnificent 3 at this point, I would call it. It's definitely still bearish. I mean, you did have outflows here and here. You're in trend lower zone on Friday. You are still negative on Thursday. And the cumulative builds, it's the same thing. The tick Q is going to measure the NASDAQ as an exchange. If I right click on this and edit the study, let's bring this up as the tick ND for the NASDAQ 100. You'll notice that this is completely flat on Friday. Once again, it's not, it's not like, oh my goodness, everything is going to zero. And we can see that divergence in the breadth between what's happening at the exchange level versus what's happening in the concentrated 100 stocks, which make up the QQQ basically and the NQ as an index product. Let's move on over to the market profile for the nasty NASDAQ. And what do we see here? It's the opposite of the S&P 500, which again, anybody surprised? Personally, I'm not. We've got ourselves value marching in the upward direction with the point of control also marching in the upward direction. There's a great excess high on Wednesday, unlike the S&P with that lackluster poor high. Decent excess here, decent excess here. So there's really no complaints in terms of structure. Maybe a poor low that could use a revisit from the Thursday session. So here's your takeaway, right? If you're going to start looking for your pullback, if you're going to start looking for that move to unfold, what do we know is basically the case, right? It's going to be underneath 19,550, underneath 19,550 in your NQ, underneath the Friday low. I would look for this to be repaired. And what's the whole premise of that trade? If we just quickly flip back over to the cash market here, underneath the Friday low, what did we just describe? If we're repairing this, maybe that's where the stronger short unfolds. So I like it also from a market profile reference perspective with that poor low. All right, we've got to do it. Here comes the IWM Russell 2000 small caps, the problem child, if you will, on the weekly time frame chart. One of these things is not like the others. What do we see here in terms of candle structure and location? First of all, nasty inverted hammer with a huge upper wick. So certainly sellers stepped up near the highs of the weekly range, pushed prices back down to the opening print, but not just to the opening print, through the opening print for range expansion in the downward direction with a very weak close towards the lower third of the overall range. I'd also just point out here that the candle body is completely disconnected and underneath the entire previous weekly range. We did produce on the bar-to-bar count a minor lower high and a much more severe lower low. So obviously the sellers and the bears have the upper hand out of small caps as we head into this upcoming week. And the larger concern really emerges from, as we know, 200, the big weekly line in the sand, being closed underneath. That starts to make this feel like, of course, a weekly head and shoulders. Now, we have not broken the neckline yet. Let's not jump the gun here. It's not Armageddon yet, but the concerns are mounting here. And if you're unable to recognize this as a red flag for the S&P 500, then I think you're doing yourself a disservice. Now, again, we're not just going out and shorting the S&P because the IWM is divergent, but if the small caps continue to break down here at least to the neckline, and the S&P offers some sort of bearish setup, I wouldn't be afraid of taking that bearish setup over in the S&P 500. Let's bring out a couple of Fibonacci retracements here just to understand whether or not we have confluence. If we come in from the bottom of the range to the top, you'll notice that the 38.2 is loosely aligned with the neckline here. That's going to be closer to 193. If we were to come in from the bottom of this latest pullback to, which this is important as well, right? From here to here, we actually have a lower high. That's the whole premise of the head and shoulders, right? But if we come into that, you'll notice we've closed right at the 61.8. If we get closes under the 61.8, which to give you a number is at 198.37, any closes below dramatically increase the odds of a 100% retracement to at least test that larger 38.2. So you can start to put the pieces of the puzzle together here and understand how the sellers having an upper hand in the small caps is kind of a concern for your broad market. When I say broad market, I'm more specifically referring to the S&P 500. Let's check in on the anchored VWAPs out of the IWM. We're still getting this cluster underneath us. So if we want to put something in the bullish category, this is certainly that. This cluster could potentially act as support for what I would argue is really at that point much more of a monthly higher low zone. I would not be arguing for like intraday bullish activity in the S&P 500 in terms of carryover, of course. And we'll take a look at the volume profile as well, just to round it out here. And I do believe we have to bring this out to a 5-year time frame. The answer is yes. And what do we see? So this high volume node, it looks like we've closed underneath. We did not get the rotation through the low volume void overhead. That again is a lack of bullish pressure here. Does not look great if you're looking for tailwinds in the S&P 500. So with all of that on the weekly out of the way, let's take a look at the daily time frame chart back on over to the IWM and get a little bit more granular here. So the expected move for small caps is going to be at 203.05 on the upper bound if contained. On the daily chart, that would suggest a big time lower high that keeps the bears in control, and obviously a big time lower low as well. 194.39 is the lower bound of this week's expected move. You'll notice on Friday the close underneath the weekly line in the sand at 200 after a gap and go. So if we're thinking about who's in control out of small caps, it's not like we have gaps that are holding. It's not like dip buyers are stepping up here. No, the sellers are the ones actually pressuring markets, continuing to pressure markets in the downward direction. If we were thinking about whether or not buyers were stepping up, they should have at least gone for a gap fill reversal. That didn't even take place. There's just no love here underneath the 200 figure, which you can see from previous examples on Monday and Tuesday of just last week. Buyers were stepping up there. I'd say the biggest failure of the IWM small caps is the massive massive gap up based on CPI and the close back inside, or I should say towards the lower third of this as a balance range, right? On Thursday, you get a little bit of an indication that, okay, maybe buyers are trying to step up off of these lows in the lower wick of Thursday's bar, but you still just close right on the lower bound of that balance range as a whole. Again, put yourself in the shoes of the buyers. If you're a buyer and you see this gap up on the Wednesday session, your first thought should be, because there was an opening drive to the upside. As a matter of fact, let's take it on down to the hourly time frame chart. I want to show you this. Here it is, right? There's your opening drive to the upside. At minimum, you should have been thinking, okay, where's the higher low over the opening print for some sort of consolidation? Not the case. This thing completely falls apart into the FOMC and beyond, right? That's sort of your Thursday breakdown as well over here. So no love from the buyers out of small caps. The buyers were absolutely flattened on that Wednesday pop and then drop into the afternoon. Again, nothing constructive here. Did buyers really step up at possibly this area at 203.25? The answer is no. Minor end of day kick up here from FOMC, but as soon as we open up on Thursday, it's just straight back to the downside. Long liquidation, new money shorts getting involved. Nobody wants to be a buyer of small caps, which again, the whole premise, the thesis of why this is so important is because it's going to start acting as a headwind for your S&P 500. So remember, we're talking bearish over here in the small caps in isolation. Doesn't mean we're just blindly shorting the S&Ps. We're waiting for that lower high, but the ingredients are there. I wouldn't shy away from a bearish setup in the S&Ps if something presents itself and small caps continue to remain looking weak here. Let's take a look at the intraday anchored VWAPs. All of these are above us. They're barreling down for a possible lower high. Even if we get a counter trend rally off of the lows, the bottom end of the daily balance, which is this area up here, is going to be confluence with the nasty cluster of anchored VWAPs. So a clear lower high can be set underneath 202. The trends are down. Let's bring out the Fibonacci's from the top all the way on down to the bottom. And would you look at that, the 38.2 keeping this as bear flag consolidation is underneath 202. So everything's adding up here in the downward direction for bears to maintain control out of small caps. Let's take a look at the market internals. Strong volume outflows on Friday as we gap down underneath the weekly inflection point. I mean, just in trend lower zone over here. Builds are in the downward direction on Thursday and Friday. There's no reason to sort of compress this. Remember, the Russell is all 2,000 stocks. So again, it's not like we have a breadth divergence internal to the Russell itself. This just is what it is. Everything across the Russell sort of index and exchange, if you will. It's not technically an exchange. I get it. Everything there is bearish, right? There's no drilling down to do here. Let's take a look at the market profile for the Russell. And again, it really speaks for itself. I mean, just clear as day, different than the S&P and the NASDAQ. Value is completely disconnected. It's not even like it's overlapping to down. It's big time, disconnects to the downside, point of control drifting lower, just ugly, ugly stuff. No love out of small caps. Now, one caveat here, like we've been talking incredibly bearish about small caps. We've been talking about how this has been falling off of a cliff. Like, don't forget, markets have give and take, right? So I would not be shocked this week if there's some sort of lower high counter trend move. It really just becomes a question of whether or not a lower high is set underneath 202. So if we really want to connect the dots and take it all the way home here, if the small caps are going for a counter trend move and moving in the upward direction, then guess what? You probably don't want to be overly aggressive on the S&P breaking down, right? So even if the S&P starts to present itself with a short setup, if small caps are doing this and rotating hard and fast into 202, maybe just think about, okay, it would be better for the short setup in the S&Ps if two things happen. Either bearish consolidation underneath 200, we'll look for drift to the downside, that's bearish pressure in the S&Ps, as and if the breakdown's taking place, or early on in the week, if the IWM wants to go for that counter trend move and find itself at 202, as the S&P 500 is stuck sideways inside of its balance range, right, the 3-day range from Wednesday, Thursday, Friday, when and if the IWM backs off of 202, that's when you want to look for the possible short from the SPY 3-day balance based on either some sort of look above and fail, lower high here, paired with the lower high here, great, short the S&P. If you're getting a range break, lower high here with a lower high here, great, short the S&P here, looking for that breakdown. You have the confluence out of that 202 in the IWM. Let's continue to get granular here by evaluating the weekly performance of the S&P sectors. Leading the pack is the SMH Semiconductors ETF, not directly an S&P sector, but massively influential. It's up 6.69%, and that checks out as being bullish as the markets are breaking to new all-time highs. Just underneath is the XLK tech sector. It's the heaviest weight risk on sector. It's up 5.96%. Another bullish check mark up here. That's great as markets are breaking to new all-time highs. However, the next one in the lineup is a massive head scratcher. A lot of people are talking about this, and rightfully so. It's the TLT 20-year bond ETF in aggregate, up 4.03% on the week, massively outperforming the S&P index itself. The S&P was, air quotes, only up 1.8%. TLT more than double that in the upward direction. So huge outperformance there. Is this a hidden risk off rotation that's being masked by what's happening in Microsoft, Apple, and Nvidia? It's certainly one possibility. Now, I'm not going to sit here and tell you to go out guns blazing and start shorting the S&P 500 just because the TLT is outperforming. That's not really how it works. But what I would say is if we start to see setups present themselves that are possible short entries, short setups intraday, I wouldn't shy away from them. Some of the relational sort of context components that the market's showing us is that things are not really all fine and dandy up here at these all-time highs. This is one of those context points. The IWM is one of those context points, right? As we look at the bottom end of the barrel, it's the XLE Energy down 2.54%, lightweight, not really overly meaningful risk on, risk off. And then it's the XLF. So this is financials down 1.57%. That's definitely emerging as a red flag here. Why is the second heaviest weight sector and also a risk on sector not participating as the market's breaking to new all-time highs? The only bullish argument I could really envision here is the rotation argument. So tech takes a back seat, takes a breather, and you start to see some money rotating around. Possibly financials pick up the slack. They would have to pick up the slack immediately if there's any sort of pullback in the XLK. And as we look at the structural charts, I'm not totally sold on that idea. Here's the SMH Semiconductors ETF. Anything bearish to say about this? Absolutely not. Higher low pullbacks, gap fill reversal on the daily. Gap fill reversal on the daily. I hate to be that guy, but on the weekly, a higher low over the previous pivot high from back here at 237 is also doable. Now, if these pullbacks start to take place, obviously intra-week, intra-day, that will be bearish pressure for your S&Ps, and that's really where we have to start thinking about, do financials pick up the slack? Same comment over here out of the XLK. There's nothing inherently bearish about this chart. Higher low opportunities look great. The structure looks great here. You could even argue for the weekly higher low over 212. Again, same commentary as the SMH. Here's the TLT just to cover it, and obviously with rate cuts on the horizon, it shouldn't be too much of a shocker that this move is starting to unfold, but the magnitude and the percentage outperformance from the S&P, that's worth paying attention to. So trendline break, expecting this to continue to drift higher. If this rights itself, it could continue to move in the upward direction, but if it's at a slower pace than the S&P, I wouldn't really read into that as like an, oh my goodness, here comes the risk-off rotation. It's the massive outperformance that is really the issue here. Here's real estate. It's over the double top neckline, and obviously this makes sense with the forecast of rate cuts on the horizon. Why would you be bearish in real estate? Consumer discretionary. Let's take a look at this one because this is do or die early on in the week off of 177.75. As we know, it's the double top neckline originally, it's the big flush point, and it's the bottom end of the balance from over here. So I like the fact that we have a higher high from point A to point B, but now it's time to prove it with a higher low back above the bottom end of that consolidation. So really paying close attention to 177.75. The biggest issue for the broad market is if some of these larger and heavier weight sectors really start making brand new pivot lows. We're not really at that point yet. We're not even close to 169.25. Hopefully I'm not jinxing anything. However, that's my takeaway here, is that we're okay sort of in the midpoint of a longer standing balance range on something like a weekly. XLU is extremely lightweight, so sure, it's breaking down. Sure, this is double top. It's also a risk off style sector. So if this does want to pull back through some of this thin structure, not the end of the world. 67.15 is the breakout point to retest. Next up is energy, certainly moving in the downward direction, helpful for inflation. Would really be paying attention to a possible oversold reaction off of 87.15. If there's demand destruction out of energy headed into the summer months, what does that say to the big R word, recession, people not traveling, people spending less on transportation? It's something to consider. I wouldn't go out on a limb and say that that's totally the thesis right now, but it's, again, that with the TLT maybe start taking not center stage, but a little bit more gravitas, if you will, in the analysis as we walk forward. Here's the XLF. One of the reasons why the rotation I'm not totally on board with is because you're already starting to get a lower high. We had discussed how this emerges as a head and shoulders, and you're underneath the neckline. So if we're thinking about rotation, I mean, maybe, just maybe, you get support off the bottom end of the range, but coming in after a failed break to all-time highs, lower high already on the table, sort of equal lows. I mean, another lower high here is fine, and then a breakdown. I'm not on board with the rotation thesis just yet, purely based on the weakness from the structural chart here out of the XLF. Now, I'm not going to sit here and say that Friday's bar is bearish. It's not. It technically closes back inside of Thursday's range after looking underneath the level at 40.45, but based on the structural sort of pattern and location that we were just describing, I don't know that we're in the clear here. I would really prefer, and I would say, okay, financials are doing okay if we're trading in the upper bound of this as a consolidation over 41.20. So keep an eye out for that into the coming week. Here's the XLP. I think that it could double top, very similar to the XLU. If it breaks down underneath this 76.25, it's a lighter weight and risk off sector. I wouldn't be concerned with a pullback here into 75.20. XLI Industrials, big long lower wick on the Friday bar, so look below and fail on the overhead range. If this is going to rotate higher, that might help dampen some of the blow if there is a pullback that unfolds in the S&P, just noting that this is about 8 percent of the S&P 500. Nothing major, but it's certainly heavier weight than the XLU, for example. Next up, materials, another extremely lightweight sector. Not reading into this one too much. Maybe the beginning stages of a double top here. Neckline is being tested. If it breaks down, it's really the lighter weight sectors outside of the XLF. So let's put a big caveat on that, right? Here's your asterisk. The XLF is a heavier weight sector that looks concerning. It looks very similar. Head and shoulders, we talked about the lower high issue, right? However, the other sectors that are really starting to suggest, okay, here's your double top breakdown neckline, like all of those sectors are your lighter weight, more insignificant sectors. So it's really those financials that pose a threat. Here's the XLC. Anything bearish about this? Not really. Pulling back from the highest high. I mean, yes, you're underneath the balance range. Tried to rally back on the Friday session. I would just say if you're over, blanket statement here, over 82.90, not really bearish. If you're underneath the breakout point, it starts to become a little bit more concerning. But based on Friday's sort of failed gap down, not sold on that idea. Here's healthcare. This is the third heaviest weighted sector by market cap. So again, is this one at the neckline of a double top? Absolutely not. So, I mean, any consolidation up here is a massive higher low, lows, higher lows, higher lows. I mean, you're pulling back, you're sort of consolidating. This is pie in the sky, inverted head and shoulders. This is the all-time high, of course. So really nothing bearish to say about healthcare, but as we know, it is technically D for defensive. So if you're a bear looking for a risk-off rotation, you could also sort of say any consolidation up here is not really great for the market, as it appears to be a little bit more risk-off in terms of posture, right? Here's the ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. These top four are the heaviest weight components. Obviously, the XLK looks fantastic as it's broken out to those highs. We know that this is really the glue keeping the market together. Financials pose a risk. We saw that on the structural chart. No concerns out of healthcare defensive activity. And the XLY, it just can't get in gear. It's really sideways in that major like weekly or even monthly balance range. XLC has not been helping recently, even though it did break out of the structural chart. Not great here on the relational chart, the relative chart. If we look at the risk off indications, this is not an issue, and this is not an issue here, breaking underneath the 50 SMA. So I would still argue that the market's trying to remain in more of a risk on mode, but it's those financials that need to play catch up. Here's the XLK SHY. This obviously is risk on. Same commentary over here, XLK XLU. So utilities underperforming, right? This is breaking back out to the upside. That's bullish. If we take a look at apples to apples here, midpoint of the range, it would be better if we could get over the top end in here. Remember that this is really a long established range. We're coming up on almost a year ago at this point. It would be better if we could certainly make some progress in the upward direction. That would certainly seem more like a risk-on indication for markets down below. We're not there yet, but it's also not like end of the world, oh my goodness, duck and cover. Here's the SMH XLV. Really speaks for itself. Obviously, semiconductors massively outperforming. No issues with that chart. So mostly risk-on with the threat of financials is the takeaway. I would say a lot of people concerned about the dollar also moving higher as the market's holding higher over here. Rates, obviously, TLT, this more fundamental approach to the market has a lot of people concerned. I think that a combination of the fundamental and the technical approach is really going to shine in what could easily become a new paradigm for the market, right? Obviously, relationships, long-standing ones, have not held the way that they typically have. So taking the technical approach, looking for the confirmation out of the price action in the index, I think is going to serve more people better than just purely saying, okay, relationally or relation-wise, utilities outperforming, TLT outperforming, let's short the market. Not quite in the new paradigm. So anyways, here is the gold contract, just to check in on gold as the dollar's rallying higher. I mean, just trying to catch support at the bottom end of the balance. I don't really see how that's a big deal for the dollar here. Let's move along to the TNX, see what's going on with 10-year interest rates. Big breakdown of our key inflection point. We know that rate cuts are possibly on the horizon here sooner rather than later at this point. So this is making sense. This is making sense out of the TLT. What's not really making sense is the dollar slightly moving higher there. So one of these things is lying. At the end of the day, if you're an S&P trader, just look for the structure in the index. I wouldn't shy away from bearish setups based on everything we've talked about so far. Again, I know I sound like a broken record, but that's really, I think, the appropriate approach as we're seeing these data points shift. Let's take a look at the inverted ZT. So, I mean, Tracker Tool should be suggesting rate cuts are coming soon. Let's take a look at the Tracker Tool now. Since our last check-in on Wednesday, no notable updates to the Tracker Tool. Still expecting 1 and 2 cuts into the end of 2024, which is different from what the Fed outlined in their latest SEP. This came out on Wednesday. They're outlining a 5.1 for the Fed funds rate for 2024, and that would only imply 1 rate cut into the end of the year. But how much can we really trust the SEP? I mean, they basically outlined core inflation staying at a 2.8. We had sort of acknowledged that, yes, there will be some basing effect that will take place as some lower reads start to drop out and maybe they're replaced by slightly higher reads on a relative basis. So I can understand that line of thinking and trying to be conservative. But again, when we're looking at the Fed Tracker Tool, we're just sort of throwing this out the window. Makes sense when this is already where we're at. So not really concerned about much of the fundamental stuff that took place this week, at least in terms of the Fed. If we look at the CPI, we know that we beat on all expectations here. The Fed held as highly anticipated and nothing interesting out of Powell's press conference. PPI continued to come in light, so another inflation read in the right direction here. However, this is where things sort of run out. I mean, if we're looking at the unemployment claims, this is the initial jobless claims. They come out every week. 242,000 is a pretty substantial miss off of 225,000, and this is the second week in a row where the miss has been somewhat severe. So I wouldn't be shocked to see the unemployment rate, the month-over-month rate, actually continue ticking in the upward direction. Remember, we went from a 3.9 to a 4.0. Jerome Powell is likely going to start getting concerned when we're at 4.2, 4.3. So that's something to watch out for. This was not great on the Thursday session. If we look at inflation expectations, they remained stable. Prior read was at a 3.3, came in at a 3.3. Remember, inflation expectations can somewhat drive inflation itself. So to see that, consumers and generally participants in the survey are saying that inflation has stabilized is not a good look for ultimately the CPI over here, more so on that year-over-year read, right? It just seems like people were like, okay, we're not at 7% anymore, and I guess that's a good thing, but it's also not getting easier out there, and that's going to be a headwind for the Fed as we continue to navigate what I see as the biggest issue here, just being the labor market really starting to tighten up probably faster than the Fed would like, and inflation not falling at the pace the Fed would like. So caught between a rock and a hard place based on this information from Thursday and Friday. As we look forward to the coming week's worth of trade, we will get retail sales on Tuesday. You can see right here at 8:30. We'll have coffee and donuts up in the penthouse for that release because the market will be closed on Wednesday for Juneteenth, and there will be no trading activities that day. We'll see how the unemployment claims come in, the initial jobless on Thursday. If this trend of massive misses continues, really starts to put the pressure on. Also, PMIs on Friday. That's interesting. I must have overlooked that. 9:45, about 15 minutes after the market opens on Friday. Should be experiencing some volatility. Earnings is mostly over. Not much to talk about on this calendar. Steelcase, I'm going to cross that out. Big Herman Miller fan, so if you've got an air on, you can rock with us up in the penthouse. You know, of course, it's the Eames Lounges, so Steelcase, no thanks. But anything else interesting? Not really. I mean, FactSet, all right, FactSet is going to report. They provide us with a lot of earnings insights anyways, so it'll be interesting to see what they have to say. Let's jump into our sort of risk appetite charts. This is the TLT ratio to the S&P. We've skipped out on this one for a couple of weeks in a row now, but it started, got to start bringing it back with the TLT up 4.03%. Notice the double bottom and the attempt to start a trend reversal here. We're going to keep eyes on it. We're not like totally risk off, oh my goodness, duck and cover, but again, a small bearish data point in the back pocket. If we look at bonds in relationship to themselves, these continue to move in the correct direction. Obviously, with the forecasted rate cuts, this is not really a surprise here. This speaks to duration risk favoring equities down below. If we look at credit spreads, this was not great. Credit spreads did widen into the end of last week. This is actually a bearish indication. Now, obviously, we have not taken out these pivot highs from the April pullback, right? When this nastiness was taking place and things were, starting to uptick here, not even close. So I wouldn't duck and cover yet. Again, nothing about this is saying S&P is going to zero, but some small bearish divergences continue to persist. If we look at the HYG in isolation, you'll see the same thing. Notice the nasty lower high and the really weak close on Friday, whereas the S&Ps remain stable inside the balance range. So once again, if there's a short setup that presents itself, I wouldn't necessarily shy away from it. I would actually be willing to consider those as possible ideas into the early stages of this week. Bitcoin is stable inside of the balance range, nothing to report on there. New highs versus lows. I mean, again, not a shocker here. Everybody's talking about this, but breath got worse as the market was really, consolidating sideways at those all-time highs on Friday. So it's making sense. It's a concentrated market in Microsoft, Apple, and Nvidia. I mean, there's no hiding from that, and you can see that in the evidence we've walked through so far in today's episode. Now, here's the SPX A200R. Obviously, 200 SMAs are way slower than the 50 SMA. So where is this in relationship to the 50% mark in terms of companies in the S&P over the 200 SMA? Obviously, about 64% of companies are still over the 200 SMA. So is it fair to say that we have huge aggressive downtrends in the market? I wouldn't think so. I mean, it's probably fair to say that some pullbacks have taken place. We're really not printing new all-time highs across the exchange and the index itself. We've seen that based on the evidence we've walked through today, but things are also not falling off of a cliff. If this was underneath the 50% mark, I would be far, far more concerned and probably, yes, actively looking for aggressive shorts in the S&P 500. I'm not currently, considering that read here. Let's look at the SPX A50R. So obviously a little bit smaller of a time frame on the look back period, underneath the 50% mark. But again, is it breaking down to huge new lower lows? Not really. I would really argue that this is much more of a compression. It would be better for bulls if this could get over the 50% mark. We're obviously not there yet. RSP speaks for itself. No new higher high, no new all-time highs. Would be more concerned on price acceptance underneath 163.63. We've talked about that for the past couple of weeks. Here's the QQQE, similar commentary. It would really have to be underneath this 86 in my view. I don't know why we don't have 86. Let's do this together just so we're not caught off guard in future episodes. So 86 is the number we care about. If we're over 86, not the end of the world. If we're under 86 and we're still pushing new all-time highs in the NASDAQ, okay, red flag, actively looking for shorts, right? Next up, let's take a look at the Dow Jones Industrials versus Transports. This has continued to be divergent. We threw it in the mix just because it sort of falls into that category. Here's the VIX. This is a small uptick on Friday as the market's really more sideways in that 3-day balance as we've described. The more meaningful thing that upticked is actually the VVIX. If you look at what's going on here, aggressively off of those lows at 75. So would I be shocked if the market decided to pull back and look for a daily higher low based on some of this volatility indication? I would tend to think not, right? Let's take a look at the volatility futures. These are set to roll, so I've already moved the contracts forward, Q and N instead of N and M. Still in a contango over here. This, of course, is bullish for equities on the monthly versus the 9-day, and the 1-day is really, really tame, well underneath that 1275. If you're looking for fuel to the fire to continue to squeeze in the upward direction, look no further than the skew itself moving right back in the upward direction. All this would imply is that people are taking some pretty aggressive bets out of the money, 30 days plus, sort of on the skew there, and they're buying puts, right? People are buying puts. If those people are going to get run over, that's possibly some fuel to the fire, right? Short squeeze is the skew here on the upside. Remember that the skew sub 113 is usually the indication we care more about, which is why we have that marker, but I did want to bring this to your attention on today's episode. Starting with your top dog, Microsoft, what do we see out of the daily time frame chart? It's bulls on parade, obviously brand new all-time highs, 3 equal highs flat across the top. That's a pressure cooker top. You've got an inside bar on Thursday. Technically, Friday is still inside of Wednesday's expansion of range, so I would call this a 4-bar play. Any bullish consolidation here, looking for follow-through up and over now the 3 equal highs at 443.15. Blue sky territories is your target up above, so $1.5 intraday levels that form, that's all we're really interested in there. You could take a measured move with the Fibonacci's as well if you'd like. If we do break down from the range, again, not afraid of looking for the short, but really changing tone on the retest of this zone at 432 to 430.75, looking for a daily higher low, right? Lows, higher lows, daily higher lows, keep the trend intact, and we would be pulling back from the all-time high, the highest high in the trend sequence. Next up is Apple. I mean, this thing was just an absolute rocket ship on Tuesday and Wednesday. A little bit of inside consolidation on Thursday, Friday. I wouldn't bet against it unless it's underneath 212. Any consolidation up here keeps everybody happy who's long late to the party. You start breaking down underneath, and that's where things get a little bit more interesting, right? So here's your Thursday low, your Friday low. If you can break and lower high underneath this area, I would tend to think that a thin structure retracement could be underway. But as we said on Wednesday, I don't know that I would personally want to step in front of a freight train here or tug on Superman's cape. I would tend to sort of be reserved in my judgment out of Apple. I'm not saying that the location doesn't make sense. Obviously, risk reward here is great, but it doesn't really speak to the percentage probability that your trade unfolds. Obviously, you're betting against momentum buyers in the upward direction. Next up, we've got NVIDIA. We're still on hourly charts. Let's go to a daily real quick just so we can understand. This is a multi-day balance. We've obviously broken to new all-time highs. Any daily pullbacks over 122.50 keep the stock bullish. Let's take a look now on the hourly so we can get a little bit more granular. Keep it simple, like very, very clear stair steps in the upward direction. Lows, higher lows, higher lows, higher lows. You'll either build out a brick here and you'll break for the exact same thing in the upward direction. Breaks and higher lows, the Brigade Bolt, up and over your Friday high of day. Longs, all-time highs, blue sky territories, rinse and repeat everything we said out of Microsoft. If we move to the downside, I'm not sold on the short in here. I would probably want the short underneath the gap fill reversal at 127. Why is that, Matt? Well, because this was a gap up. Dip buyers stepped up at 127. If they're still waiting there, if people didn't get filled at 127 and still like the price, I don't want to be trying to go short here until we're actually under with a lower high, looking for that daily higher low pullback that we were just describing at 122.50. So the trend is your friend until it's not, and I would argue that this is really the only short out of NVIDIA. Back to some dailies. What do we see out of Google? I want to go to the daily here to talk about the sloppy activity in this box up here, the failed break to new all-time highs. This has been a pretty difficult range to trade out of Google, so this one falls lower on the tier list of setups to be watching. I think consolidation in here is tough. I don't really know what you would aim to accomplish in there. I would tend to think that this is at least an idea to get back up towards this inflection point, so over 176.75, trades 178.25. To the downside, I'm not sold on a breakdown short. I would probably only want shorts out of Google if we're underneath 173.25. If something like this were to emerge, then possibly looking for daily equal lows down here at 169.65. Really a lackluster chart, so we're moving on. Next up, Amazon. Much, much cleaner in my view. Let's go to a daily chart because I do want to talk about, there's some push and pull. The daily chart, not great inside of this box. Balanced, you've got equal highs, equal lows. But if you look at the hourly chart, right, we've been talking about in the pre-market prep the strength of this trend off the lows. I think you've got a meaningful pullback, and I think it's time to start thinking about daily higher lows to be more constructive on the daily time frame chart, right? If we go back here, and if we were to hold low, higher low here, and make it back up to the equal highs, I mean, let's just go back to pattern trading 101. There's a massive ascending triangle. Could Amazon be the name to break to new all-time highs, higher low above, and continue in the upward direction? Think about what that would do for your XLY. Obviously, that keeps somewhat of the rotation in force, and I do like the structure on the hourly chart, right? So the daily bar is technically a hammer down here, something that looks like this. It's finding support in the upper 50% of the previous balance range here. I would try to be aligning with any sort of inverted head and shoulders like this, Brigade Bolt, up and over 183.75. If you can spot this higher low, thin structure retracement, aiming for these highs as a zone. So that's the deal out of Amazon. Let's move along to the metaverse daily chart to begin. Consolidation over this breakout point looks good to me. I don't really see any issues with this. I like the mild pullback. It has not been aggressive. If we take a look at the hourly, I mean, maybe you could build the argument that we're starting to get a little bit of a head and shoulders like this. I would really just keep it simple, right? 501.25. If we're above, there's absolutely no short. We know that this possibly turns into an hourly double bottom. Higher low over the neckline, 505.50, trades back into, ideally, the equal high from back here to get daily continuation higher. If this is going to be some sort of bear flag with consolidation on the lows, again, in the spirit of keeping it simple, lower high underneath is just a range rotation from back here. 493 is the possible target. So keep it simple there out of Meta. Tesla, the absolute heartbreaker. Here it is on the daily chart. Can't get out of its own way, even as the shareholders vote that Elon Musk is awarded with another $56 billion in compensation. I hope he does awesome things with the $56 billion. But the chart, I mean, I'm not... Great, he's got his money. I'm not really willing to throw my money at his ticker here on Tesla. I don't see the love, right? On the gap up, on the announcement, a couple of things should have taken place. If you go to a 5-minute chart here, really, really quickly, just for the sake of exercise, right? On the gap up, gap fill reversal, partial over 185.75. If this was going to stick, that was the time to do it, right? If you go back to an hourly here and take a look at the structure, that would have been clearing this, and we would have had clearance, so to speak, into or through some of this crappy structure off to the left. 198.85 didn't take place. No love at the 180. As a matter of fact, it's bear flag consolidation back inside of this range. So Tesla, you can probably hear it in my voice. I wouldn't say I have a grudge against it, but really, it's just kind of a heartbreaker. It's been, it used to be an awesome trader, not so much over the last couple of months here. JP Morgan, what's going on over here? Definitely more interested in this setup. So again, if financials are going to perform, I like this as a possible long. This idea here is worth entertaining over 194.25. If you can spot the higher low, notice that sellers had a chance on Thursday. We made a lower low underneath the Wednesday low. And on Friday, we also opened underneath that Thursday opening print, underneath this afternoon pullback. You can even see in the upper wick of the first hourly bar from Friday that sellers attempted to keep us underneath this area. However, it acted as support into the afternoon. So if there is going to be a rotation into financials, I think that this is a watch out of JP Morgan. There's your trade right there. Thin structure retracement over 194.25, trades into 196.35. If it's consolidating weak on the lows, so be it. Call it for what it is. Here it is on the daily time frame chart. You have a bit of a downtrend emerging with lower highs, lows, and you're consolidating with lower highs. That's this here on the hourly, right? Underneath the overhead supply. That's bearish. And again, take it at face value, probably looking for lower targets over time. Next up, Netflix, really, really strong breakout on Friday, just an absolute runner out of the gate. So keep it simple, higher low consolidation, continuation over time. Let's see if it flips back into the mode of what it was doing back here, what it was doing over here. Some really great trading opportunities back once we finally identified and were willing to change tone out of Netflix. Let's see if it goes back into that mode. So first higher low, 663.75. Ideal, or just sort of line in the sand more appropriately, higher low is 656. As long as it can stay over this as an ascending triangle retest, you could even, go way out on a limb and call it a higher low double bottom. As long as you're over that origin of the breakout, I would tend to think you're still leaning a little bit more bullish out of Netflix. Finally, AMD, another heartbreaker trade very similar to Tesla. I would argue this is more bearish though, and it's actually setting up a bit more respectfully a pattern here. So we've got ourselves the descending triangle. Sellers are continuing to make progress in the downward direction, flush the lows, and we are looking for continuation into this lower zone. 153.25, 151 is the target, and the breakdown area is 158.25. 3 trade ideas for you. The first one is LLY, Eli Lilly. Let's take a look at the daily time frame chart. And let's see what we can see. So this, of course, is in the healthcare sector, and this is priced appropriately. The options they're decent over here on Eli Lilly. They tend to get a little bit spready because the volume can be a little bit thin. However, this is certainly worth keeping tabs on. We have a daily 3-bar play. It's probably even more than a 3-bar play. Notice that this bearish gap up, right, which fades, then has an inside bar on the hammer, inside bar on the green bar, and another inside bar on the Friday session. So if this wants to break through the equal highs, I think, it's obviously just blue sky territories. There's a possible long entry here. Daily swing traders can be looking to manage risk like this and look to 2x that in the upward direction. You're probably looking at just over 900, or even intraday traders. If we take a look at the hourly time frame chart, consolidation here, and you guys know the deal. It's the Brigade Bolt up and over 884.50. Risk that looks like this. There is your intraday setup. Blue sky territories overhead. That's Eli Lilly as your first idea. Next up, ANET, ANET for Arista. What's going on with the networks? Let's take a look at the daily chart to begin, and what do you know? It's another bullish 3-bar play. So if we're long over the highs at 331.75, thank you Thinkorswim, by the way, for the precise click at the quarter. 331.75 does what? It breaks out to, I believe, let me double check on Arista because I have not double checked this in a while. Yeah, this is clearly new all-time highs out of the networks. Let's go back on down to a daily and flip it to the hourly. Same concepts as what we just described over in Eli Lilly for the intraday setup, something that does this. Brigade Bolt, 331.75 is your level. It's in play as long as Friday's low holds, and that would be at, let's call that down below at 325.25. I like that because on the expansion of range day, which was Thursday obviously here, notice the initial rejection, consolidation underneath, and then stronger break into the close. So as long as we're over that, I would tend to think that this setup remains in force. Last but not least is AMAT for Applied Materials, and we can see on the daily time frame chart, if you notice the theme, inside bars all stacked up here. If that breaks out, bullish, and that's over 238. I do believe, let me double check so I'm not lying to you. Yes, new all-time highs out of Applied Materials, obviously having a lot to do with the semiconductor space and the requisite components to make those chips in the first place. Let's quickly go down to the hourly. You can just get the sense. So here's a takeaway out of this one. Notice that you open on that Thursday session near the open of Wednesday, no catalyst there, and it's just right back up to the high. So sellers had an opportunity to turn this into overhead supply. It didn't work. Then you made a higher low on Friday, right back up into the equal high. So looking for that repair over 238, aka a breakout, higher lows that hold above, looking to go into those blue skies. So that's what I've got for you in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. You can remember to follow us over on X for more chart updates over the course of the weekend. Remember, the markets will be closed on Wednesday as well for Juneteenth, so you can sleep in, you could take the day off, you could do whatever it is that you want to do. We'll be live up in the penthouse on Monday, Tuesday, maybe Wednesday. We'll do like a live midweek market update. I don't know. I haven't figured it out yet. Depends on what we're going to sort out that day, but markets will be closed, so we'll be live every other day of the week, maybe Wednesday. We hope to see you up there in the penthouse. With that said, I wish you a green trading week, and we will catch you in the next one.